So one thing I want to say is that when you have to start a forex trading, one thing everybody have in mind is the ability to make money within 1 week. You are rich. Within 1 month, you are rich. I can assure you that it's not that quick. It's not a quick money making. It's not something that you enter, you believe that once you get in, you are going to make billions, millions, and all that. And it's not something you gamble. So you just need to have that at the back of your mind before you start anything forex. And there are many processes in forex. One, patience, determination, and ability for you to stay very strong in what you are doing and believe in it. Determination, most especially determination. So it's very key and very important that you must highlight all these points before you decide whether you actually want to be a forex trader or you just want to be someone who want to come into the system just to understand how to make money. If that is your system, if that is what you want, there are many means of making money. You can do streaming, you can do day job, you can do um, freelancing, you can do a lot of process are online where you can do that. Remote jobs, they are all online. So it's not compulsory that you must do forex to make money, right? So that is what we're going to look at today, beginners class, and that beginners class is going to be starting from what is forex and why we have to go into forex. If that is what you want and you are part of the people who want to become financially free in the next few years to come, this class and this video is for you. So let's begin the class by taking step by step on how to trade forex as a beginner. The important thing here is we need to understand the basic and history of forex, and we need to know how the market works, currency pairs and sessions you need to understand on how to trade, pips, lots, leverage and merging, and the margins you need to understand, the reading charts, candlesticks, technical and fundamental analysis, support, resistance and the trend, risk management and psychology, trading plans and platforms, placing trade and real examples of different type of trade, math versus reality, and the last one will be resource and roadmap. All these are going to be part of the class we are going to complete today, and that is why we target as complete beginners to confident roadmap. Shows that once you are done with this class, you should be able to have a full knowledge of how forex works. Do not go anywhere. If you have not subscribed, subscribe now before we dive into the details so that whenever the forex videos or any of the financial video we upload at this channel, you won't miss out. So let's go. What is forex? You see, people really don't understand what forex is all about. When you mean forex means foreign exchange. Foreign exchange, you are bringing two things, the F and S, which is the forex and the exchange, together to make forex. And the forex are different pairs. We have US dollar, we have euro, we have Canada, we have every countries have their currency pairs. So that is what we need to understand today. Now, traders aim to profit from changes in the exchange rate. For instance, if there are movement within the euro of a volatility within the euro, you see traders tend to buy USD, euro against USD. Then if there is anything happen within JBP, within JPY, the JPP will be moving while the JPY will be selling. So these are part of the things that you must understand about how forex works. And forex is the largest financial market in the world. The largest financial market in the world. What trillions of exchange. Now it works 24 hours, and that 24 hours it works 5 days in a week. The ones you can trade that are not 5 days in a week are more of cryptos and synthetic indices. Those ones can work 7 days in a week. So that is how forex is. And in the real world, let's look at the analysis. If you're traveling within Nigeria to the United States and your exchange rate is 1,500 for a dollar, if the naira weakens against the dollar after you have already converted, your dollars are now worth even more in naira. So that is the reason why sometimes it's either it pays you or it reduces your money. So it's either you are buying or you are selling. At every given time, there will always be a need to buy, there will always be a need to sell. Now let's look at the history. The history of Forex started many years ago. In 1875 to 1914, the gold standard, which is currencies were backed, the gold standard currency were backed by gold reserves, creating fixed exchange rates. And in 1944, the Bretton Woods Agreement, which is the US dollar, became the world reserve currency pegged to gold. In 1971, the Bretton Woods collapsed, currencies moved to a floating system. Exchange rates floated or floating freely within the countries whenever dollars are being involved. In 1970 to 1920 into year 2000, 1990 to 2000, rise of electronic trading platform opens the market by to banks and large institutions. So that is when we started having people who started tend to come into the market industry. In 2000 to date, online retail brokers, MT4, MT5, C traders, all of those came on board and market started taking advantage. How Forex market works. There are different types of Forex traders. We have the central banks, we have the commercial banks, we have the brokers, we have the retailers. We are the retailers because we have just little money we trade with. So some of these trades are trades that depends on the volume and the amount you actually have that will give you the range or the level of area where you belongs to. The most of these people are the banks are the major ones, which are the major big banks, and they trade more of the commercial aspect, which the central bank is the overall. So in this context, trading happens electronically over the counters. Those who are on over the counters between the global network of banks, brokers, and traders. For instance, you have the Bureau de change, you have the exchange dollars at the airport, on the street of different locations across the market zone or area. Prices are driven by supply and demand. That is the truth. For instance, if dollars were scarce, you can't access it, the prices will go up. If dollars are being in place, you can remember years back when Nigeria's dollar were almost 2,000 because there was scarcity of dollar. People were holding it, and that makes the price to go up. These are part of things that drive the market. That is under the OTC, that is over the counter. The major participants are central banks, commercial banks, hedge funds, corporations, and retail traders like us. So traders are differs based on the fund you are trading and based on what your ability to manage the trade. Now, major, minor, and exotic currency pairs. There are different type of pairs. We have the major pairs, we have the minor pairs, we have the exotic pairs. The major pairs are those pairs that are actually more conversant in the market, which are the Euro USD, GBP USD, USD JPY, USD CHF. These are major pairs. Then the minor pairs are Euro JBP, JBP JPY, USD NZD, while the exotic pairs are USD TRY, USD. In fact, the exotic is totally out of the system. USD Nigeria or NGN, they are totally out of the system. So we don't really trade on exotic, but you can trade major and minor. Major and minor can actually give you what you want. So some of us who are good traders, we already know the essence reason for major pairs because of the volatility. You cannot enter a trade buy and sell when there is no volatility. It's only a market that has volatility like USD JPY, USD CAD, Euro USD. These are major pairs because the volatility is there and the market is moving. So you can actually enter that market at any time you find yourself in a situation in the Forex exchange, right? So while we do that, you also need to understand the minor pairs are also very good. Euro JPY, GBP JPY, GBP USD, USD JPY. These are minor pairs, but they are still very volatile and very good to trade. So the exotic is totally and avoidable. So don't go into exotic. Now, pips, lot, spread, leverage, and the margin. These are what makes trade to move. The smallest price move in a currency pair, usually the fourth decimal. If you check the zero within the first 0.01, you have uh, you have 0.0001 on that aspect of the trade. So on that level, most of those pairs are not moving. So it counts from 0.10001, that is Euro USD. If you check the the moves on Euro USD, you have 1.0850. So that means among these is moving with 1 pip. So the lot is a standard trade size. Standard lot, that means for instance if you want to trade 1 lot, 2 lot, 3 lot, it depends on the amount you are now want to consume or take from your account. So it's always very good that you be careful on which of the pair your lot you trade, because that's where the risk management comes in. So 100,000 units minor lot is 10,000, while micro lot is 1,000. So all these are area you must understand carefully before you know what to do. So most cases you hear what somebody say use 0.001. It shows that they want you to not to over leverage, so that you can have access to a good risk management. So on the spread, we have the difference between the buy ask price and the sell bid, which is this is the broker's free for the trade. So the spread is what you enter. For instance, when you take your trade, the first few minutes you see that you are on minus before it goes to the positive. That is the spread. So each brokers have their various spread. That is why sometimes you mind the kind of brokers you trade with. So if you need to have a good brokers, click the link below, join our Telegram. You will see all the brokers we trade with, so that you can as well leverage on what we have researched on. So on the leverage, borrowed capital that lets you control a large position with a small deposit, e.g. a leverage of 1.100 means $100 controls $10,000. So a company you trade with or the broker you trade with must give you a leverage for you to be able to assimilate or to trade your small account, so that you won't get blow. Because if you don't have a good leverage, your $100 cannot be able to trade effectively for you. That is how leverage work. So your margin, the amount of your own money set aside as deposit to open and maintain a leverage position. So that margin where your account you are running and your leverage the broker is giving you is in between what set aside your deposit and what the broker is giving you. So you must understand this very, very clearly and effectively. Now let's take the forex session. We have different sessions in the market. We have, we told you it runs 24 hours, but that 24 hours is not each continent or country that actually runs in a particular 24 hours. They have different sessions. That session is also very, very important, that you need to understand why the session. The session, it matters your location, ability for you to trade, where are the volatilities being located. You can't trade at the session where there is no volatility. Your market will be on just the ranging. And remember, we don't trade at the ranging market. Even if you have to trade at ranging market, you must be sure of the support and resistance are very, very visual for you to trade, right? So you must understand your sessions to be able to take effective decisions. Now let's look at each of the sessions. We have the Sydney session. Most especially, for instance, on Sundays, the Sydney is the first that will start from 10 p.m. to 7 a.m. in the morning. So for those of us who are in Africa and part of the Europe, we prefer trading the London time, because that is the time we'll be very active, and the market that has more volatility, which is the New York and the London kickstart as early. But the Tokyo starts from 12 a.m. to 9 a.m. Some people also trade Tokyo because at that time volatility is picking up, but the best time is 8 a.m. to 5 p.m., which is the London time. And the more volatility period or session is the 1 p.m., where the New York is joining the London. It becomes more heavy and you see more of movement at every pace. So my advice is, if you are in Africa, in Europe, London and New York is the best time to trade if you are a day trader. If you are not a day trader, you can set your take profit and your stop loss, allow your market to swing for days, for weeks, then you don't really mind about your volatility. But you can set your entry level at the volatility time so that you know the market direction. Now, how to read forex chart? On this forex chart, we have the horizontal, we have the vertical line, and each point on the chart represent the price at the moment, at which moment of the price is giving you. So three common chart types is the line chart, the bar chart, and the candlesticks. And these things you must understand them. We're going to be taking that. When you enter your practical experience, you will see the line chart, the bar chart, and the candlesticks. Then the candlestick charts are the most popular. They show open, high, low, and close price for, in fact, 80 to 99% trade the candlestick chart, which is more described and more understanding. So at this level, we take you to the candlestick patterns. The candlestick patterns, every beginner should know. You have the high and the low, the close and the open. That is what this anatomy of a candlestick is explaining. There are going to be a video where we will explain detail of sessions, detail of candlesticks, and detail of all these things we have highlighted. We'll be taking them one after the other on each video so that we can practicalize it to you. But at this point, just have a knowledge of how all the beginners things we are going to be having. But we're going to make another video that will give you practical session on how these things are being worked on. Now let's look at different type of candle. We have the doji. Doji is one of the popular candlestick. Whenever it happens, it closes to a particular session, you can easily determine the direction of the market. That means when it opens equal to close, signal indecision in the market. That means it's closed at a particular place and it becomes an indecision in the market. Then the hammer, small body, long lower wick, often signals a bullish reversal at bottom of a downtrend. So what does that mean? We call it a hammer, and you see that hammer is directly on each of the pairs as you trade. So that means, as it's called hammer, there is always going to be the candle reversal will move to a particular place and close at the edge of the candle. That is the direction of the trade. Then shooting star. At the shooting star, the small body, long upper wick often signals a bearish reversal at the top of an uptrend. So all this will be shown to you as we move ahead. Then engulfing. Engulfing is a larger candle completely engulfs. The previous one signals a strong reversal. So all this will be shown to you while we move on. So technical analysis versus fundamental analysis. What is technical analysis? Technical analysis are those lines, uptrend, the level, the volume, the support and resistance. You must understand how it works. Sometimes we use indicators like moving average, RSI, MACD to identify our movement of candle. Same focus on what price is doing at a particular time, the candlesticks, the chart patterns, the top head and shoulder, the the bottom, the double bottom, double top, all these are part of candle technical analysis or chart analysis. You can understand the technical trade. Then fundamentals are the news. We've said it over and over many times that fundamentals, when it comes to fundamentals, you need to understand how it works, most especially study economic data, news and events. Like today, I think the Prime Minister of UK has changed. A lot of things will change. Well, a few weeks back, the Central Bank of the United States, which is a lot of different analysts, Trump and co can make up any news, and that becomes a very big issue in the market. So fundamentals are the news and the event, political event, ecological event, Iran, whatever news that want to come up that will affect the market. Then the support and resistance, you're talking about where the market has one touch, two touch, and the third touch, that is the resistance. On the bottom, which is also referred as the support, we have one touch, second touch, third touch is the support. Most people trade this range, just pick on support and resistance, and it goes that way. Then support, a price level where buying pressure tend to stop. A downtrend, what is the floor? Then resistance is a level where selling pressure tends to stop, and uptrend. So it works in both sides. That is the ceiling type and the floor type. The floor is the support while the ceiling is the resistance. Then price often bounce between this level until it breaks. So we trade that also, which are people that normally trade support and resistance. Is a very good strategy. Then this level are drawn from previous highs and lows of any chart. Many traders buy near support and sell near resistance. So that is always a very good trading strategy. Now, what is trend line? Trend lines are market structures. You have the uptrend, you have the downtrend, you have the ranging, and you have the high and low swings and all that. So all these are markets where we have higher low, higher high, higher low, higher low, higher high. That means it's an uptrend. But when it's on higher low, lower low, higher low, lower low, higher low, lower low is a downtrend. Then when it becomes higher high, higher low, higher low, is not higher high equal high, becomes a support and resistance level, not uptrend, not downtrend. That means equal high and equal low. Now, risk management is a very big factor when it comes to trading forex. How does that work? Every risk you consider in what you do, most especially we don't risk with above 1 to 2% of your personal account. Very risky. The position size is how much you trade based on your account size. You can enter 1, 2, 3. But if you are to risk one trade and you are entering 1%, and you are taking one lot, one position as 1%, and you are entering 3, automatically you are entering 3% of your account. So it also depends on the lot. So if your lot, you divide your 1% by 0.25, 0.25, and you decided to, or 0.5, 0.5, and you decided to take it to position, you are still on 1%. So you better understand how to trade 1% on different position, right? And a good risk to reward also important. For instance, if I'm risking 1%, I am going to get if I'm risking $100, I'm looking forward to get $200 as my profit. That also help me. Whenever I have losses, I can easily use my profit I've made in one risk to reward, which is RR, for 1 to 2 or 1 to 3 to recover my losses. So these are explanation we have just explained here, that if you have an account of $1,000, your risk of 1% is $10. Your stop loss, sorry, your $100, your risk of $1,000, $10. Then your stop loss is 20 pip. So that means your position size of $10 divided by 20 pips is equal to 0.50, which I said earlier. Now, your loss should be 0.05 loss. If you are now entering 1 point something, you are automatically taking above your risk. Then if the trade hit take profit at 40 pips, you are made 1 to 2 reward. That means your $20, your $10 will turn to $20, right? Trading psychology. These are major common problems our people face every time. Ability for you to hold yourself when the trade is going up, ability for you to understand the trade whenever you are on a losing streak. So over trading is one of the trading psychology. Sometimes you are losing, you want to trade back, you want to put in more trade, you want to see what you can do to recover. These are psychological issue. Revenge trading, when you lose, you enter. When you lose, you enter, believing that the market will pay you back. It's never going to be the answer. Now, the third one is the stop loss. Whenever you are on the losing streak, you keep adjusting your stop loss to see that if market will reverse back. All these are psychological challenges. Chasing the market, yes. Whenever you want to enter market, you don't check your analysis to be sure that it's in order. You just enter market because you feel that the market will miss or will lose or will leave you. Market can never leave you, but that is why we have different pairs. If anyone leaves you and go, then you leave it, then go back to another pair and start your market. So there are different opportunities in every chart that you can get. So ability for you to endure and get patient over the trade is what is very, very important. Now, trading and with emotion, which is ignoring the plan. And so it's always good that you have a trading plan, because if you lack a trading plan, it automatically shows that you can never trade as a good professional, because a trading plans will always enable you to have trade with a very calculated plans. Then you don't trade with emotion, you don't trade with feelings, you don't trade with whether the market is losing or is missing you. Whatever you have a loss, if you are to stop, your plan says stop for that day, you stop. If you say go on, you go on. So you must understand how trading works when it comes to this type of system. But we are going to have a very good plans for trading. We're going to do a very good video for you on this. So that is the reason why we said, please just click the likes so that you can always get all our videos as we present all this to you. Now, creating a simple trading plan. Simple trading plan can make you a very high reward in Forex. Market and time frame you're going to trade, the currency pair you will trade, the timing you will trade, whether in 1 hour, 4 hours or 15 minutes, and the entry rules. What are the things you see? What conditions do you see? Your price, your candlestick, your level, your Fibonacci, whether you're using the indicators or you're using trend line, what do you see before you enter? It's very important. Then your risk. How much will you risk per trade? Where will you stop? Are you making $100 from 1,000 account you have, you stop? Or when you make your 1,000, you keep trading? We've all made all these mistakes. Whenever we have profit, we tend to continue believing that the market is still very easy until we keep losing all the profit back. But with your trading plan, you will achieve this better. Then trading journal. Your trading journal, it's all about what actually you need as a trading journal. Your record, every step, every decision you take. Then your entry, your exit, your reason of taking that trade, the outcome, your lesson, and what you learn in every of your trade must be considered in every trade before you make any decision. So in this regard, we're going to let you know that in this regard, we're going to let you know how we can have a trade when it comes to a trading plan. We're going to do a very good video on this trading plan so that you all have it. So that is what we're having presently. So on this mode, trading plan is very, very key and is very, very important. So let's go on. In relation to trading platform, you will have to go to your mobile phone, download MetaTrader 5. I always recommend Trader 5 because MT4 is a bit, there are features in MetaTrader 5 that is not in MetaTrader 4. So just follow that. Then your trading view is for your chart analysis. where you can do charting analysis, do a lot of things that you can put in place. Now, your watch list, your chart window, your order window, your accounting histories, everything will be displayed on that. Well, your trading view is very, very important. You must understand how to do chart and analyze and believe in what you see before you go to MetaTrader 5. There is also a demo in your MetaTrader 5 where you can trade your demo for a temporary time. So you don't just jump into profit using your real account. So some of us sometimes we jump into conclusion by making sure that because your demo is giving you profit, you just move into profit as I'm believing that you are making money. So it doesn't work that way. So practice make perfect. How to place a buy and sell trade. The buys are always on the green while the sells are always on the red. So on that note, the buys are always coming up. Open the order window for your pair, select buy or buy market, set your lot size, set your stop loss, take profit when your price get to a level, and then confirm your trade before you enter. On the sell, it means you are short. Then the buy means you are long, while the sell means you are short. There is another word for a sell when you say short. So open the order window for your pair, select the sell market, then take your position size based on your risk, then your stop loss based on your risk, your take profit based on your risk to reward, which is the ROR you want to, then confirm the trade if it goes your way. So all these things, we're going to be practicalizing it in the next video. Please do not miss the next video. Now, these are the charts, the way you will see the chart example. When you are to buy, you click on this. This is your stop loss that show red. This is your take profit above. So when you enter a buy at this zone, it means you are buying up to go to your stop loss or your take profit. So that means you are moving up or you are long. So that is what the analysis trade details. JBP USD, direction is a buy, reason price bounce off support with a bullish candle. Your entry level is the market description where you have at the level where market was, which is 1.2650. Then your stop loss is below, which is about 30 pips below the market. Remember, we said is 40 below, after the 0 point is your pip. That is why you're having 30 pip behind your pips. Then your take profit is the 1.27106 above. So risk to reward is 1 to 2. So always have that at your consideration at any time you want to take your trade. Now, what are the math and the reality? You can get rich quickly, that is the truth, but the fact remains that it takes time. Now, the reality is that consistent profitability takes months or years of learning, practice, and discipline. Now, the matter is that you need to predict the market perfectly. And the reality is successful trading is about managing probability and the risk, right? Now, that is the reality. The reality is high leverage, dramatic increase in the risk losing your account quickly. That is more leverage, more profit. Now, the signals and robots guarantee success. The round that no signal or both removes the need for risk management and a sound strategy. Now, the last one is you need a lot of money. Yes, you don't trade without money. Then many brokers allow you to start with small amount, but that is just for the beginners session. Recommendation. We recommend learning resource for beginners. You must have free education. That is why this YouTube Datapoint Online Academy is there for you, where you will learn the baby other beginners class like the baby pips, school of baby psychology. Sorry, the baby pips is where you learn a lot of things. Then Investopedia for session, broker provided education helps, a lot of different companies are providing learning for us for how to have a free opportunity. Then the practical tools you will need is demo account, which is on MetaTrader 5, trading view, which I just showed you, you have to download that. In some cases you have the free version. The economic calendar, where you have the forex factory and investing.com, where you have to learn a lot of opportunities, how you can begin. And do not forget that most of these things I've mentioned, they are all free. The communities and mentors, we have like Datapoint, we have our YouTube page, we have our Instagram, we have our Telegram, and we have our YouTube, which is the major source of this information. Then all these ones you can as well join to get a community support. Now, how do you do your demo? The demo account, practice with demo, because I said it earlier that forex might be very funny. People will assure you that, oh, whenever you enter, you are sure of getting a lot of money and all that. No, it does not work that way. What is important is for you to have a demo account, practice it very well, and it enables you to be able to practice what you are going to do when you are on the real market. But the disadvantage is that it's not withdrawable. Sometimes we tend to overtrade. For instance, somebody want to take a start with $50 or $20. He will be trading with $10,000. You have to trade the demo with reality account, relating with what you can trade when you have a small account. So that is the way I advise people to trade a demo account. Now, how much money do you need to start? You can start with anything, depends on your pocket, depends on your source of income. But what I always advise is that don't trade forex if you have no work or source of income, whether small or big. Start with something. Consistency and ability for you to master the trade will make you profitable. In micro, you can start with 10 to 100. In standard, 100 to 1,000. In growth stage, 1,000 and above, you can start. It all depends on what you're able to get. But if you don't have, remember, we said demo is there. You can run demo account to start. Now, key takeaway for this trading for today. Forex is the global market for exchange currencies, traded in pairs for 24 and 5 days. Now, 2 is understand pips, lot, leverage, and margin before placing any trade. The third one is use both technical and fundamental analysis to inform your decision. The fourth is support resistance and trades help you to find good entry and exit point. The fifth is risk management. 1 to 2% per trade is very okay. Stop loss or non-negotiable is a must. And the last but not the least is written trading plan, trading journals, and build consistency and discipline along with your trade. This is the take home for this training for today. And above all, your roadmap to becoming a profitable trading or trader is sure. You can have the first 1 month, you're learning your fundamentals. Your second month, build a test and a strategy. Your third month, trade with demo and be consistent. The fourth month, go live. The fifth month, review and refine, and continuously going, scaling up gradually. I can assure you, before you know it, you are up there. And your frequent questions you may want to ask are all available. Go to our comment section, comment, and tell us what you want to know about us, how you want us to help you, how you want trading to be with you. Is trading a gambling? Yes or no? The answer is no. Do I need to be a good at math? No. Basic arithmetic is okay. You can understand how to do 1 plus 1 is 2. You can trade. The third one is, can I trade forex part-time? The answer is yes. You can use a swing trade by 4 hours entry. You can become a good trader. And the final one question or any other one is forex trading legal in Nigeria? The answer is yes. The answer is 100% yes. It's not a scam, it's not a gambling, it's not an avoidable system for Nigeria traders, Africa, and across the world. Now, any other questions, I'm going to leave this on our chat where you need to understand the full meaning of PIP, the full meaning of lot, the full meaning of spread, leverage, margin, bullish, bearish, stop loss, take profit, support and resistance with liquidity. All these are going to be stated all through our trading on this video. On this note, I want to thank you once again for coming to always support us, listen to us, learn with us, and we assure you as we do this trade together, we will continue to grow with time to time, and as we move, surely that trading is profitable, and in long run you will enjoy the benefit of your work. Thank you and do have a wonderful day and week